Welcome to vTalkInsight, Allocator's Lens Daily for December 2, 2025. Markets are starting December pulled between powerful liquidity, an AI-driven growth story, and growing doubts about central banks. Cross-asset signals today are unusually noisy, equities are still close to recent highs, yet sentiment feels brittle, rate expectations are whipping around, and commodities and currencies are flashing conflicting messages on inflation and growth. Let's unpack what that mix means across the main asset classes. In equities, December opens with a tension between strong recent performance and a more nervous tone under the surface. The S&P 500 has just climbed toward the 6,800 level, while implied volatility slipped back into the mid-teens, signaling a fairly relaxed options market. Yet futures softened into month-end. The first trading day of December finished lower across major U.S. indices, and small caps underperformed, all consistent with more risk-averse positioning. Two big stories are doing most of the work for equity bulls: artificial intelligence and expectations of easier monetary policy. Current pricing suggests stocks are discounting roughly 75 to 100 basis points of Federal Reserve cuts over the coming year. That provides a clear upside narrative if central banks deliver, but also creates a vulnerability if they do less than markets hope. At the same time, AI-linked megacaps continue to dominate index earnings and market capitalization, keeping overall valuations elevated and concentration risk high. The AI complex itself is pulling markets in opposite directions. On one side, some sell-side houses see scope for the S&P 500 to reach around 7,500 by 2026, assuming widespread AI adoption boosts both equity and credit markets. Nvidia still commands an overwhelming share of the GPU market, remains supply-constrained, and is deploying its balance sheet into partners like Synopsys, Intel, and Nokia to lock in future demand. On the other, there are clear signs of what some describe as a bubblelet, with circular financing, heavy vendor deals, and capex surges that leave margins exposed if AI-related revenues fall short. That tension is driving rotation beneath the surface. Investors are increasingly exploring European and Asian markets, as well as select emerging economies, attracted by cheaper AI-related exposures and lower implied cost of equity than in U.S. large-cap tech. European indices have traded with a defensive bias, with staples and grocers faring better than industrials and defense, even as geopolitical risk around Ukraine and European security budgets remains elevated. In the U.S., robust nominal retail sales and strong Black Friday revenues support earnings, but inflation-adjusted volumes look much more muted and spending is clearly bifurcated between higher-income and lower-income consumers. Flows and structures add another layer for allocators. Cash balances in money market funds and time deposits remain very high, and there is roughly $3.5 trillion in retail time deposits that could migrate into equities if rate cuts materialize. Options markets, including VIX futures and put-call ratios, are flashing signals consistent with scope for a year-end rally, even as many investors prefer downside buffers via defined outcome exchange-traded funds. Against that backdrop of liquidity and AI enthusiasm, equity markets look heavily reliant on a dovish Fed and on continued tech leadership. The key watch points now are the upcoming Fed decision and guidance, AI earnings and capex plans, and any shock that tightens financial conditions and challenges this liquidity-supported equity regime. In rates, the center of gravity is the next Fed meeting and who ultimately leads the central bank. Fed funds futures have moved to price more than a 100% probability of a cut this month, and broader curves embed roughly 3 to 4 quarter-point cuts over the next year. Some forecasters talk about a path toward a 3 to 3.25% terminal range, while others expect only a single cut, highlighting just how wide the distribution of views has become. This aggressive easing narrative sits uncomfortably with the inflation backdrop. The Fed's preferred core PCE gauge is expected to run at around 0.2% month-on-month, leaving annual inflation near 3% and still above the stated target. Several commentators doubt core inflation can sustainably reach target before late next year, and note that policy rates remain roughly 200 basis points above many estimates of neutral, even after meaningful disinflation and higher unemployment than before the pandemic. That mix fuels debate over whether cuts are justified at all, or whether policy is already too restrictive. Market behavior reflects that uncertainty. Implied probabilities for rate cuts have swung from about 90%, down toward 30%, and back into the high 80s in a short space of time, underscoring how little confidence investors have in the Fed's reaction function. 10-year Treasury yields have oscillated around the 4% level, at times dipping below on speculation about a more dovish Fed chair, and then snapping higher as global factors, including Japanese bonds selling and inflation worries, push the entire U.S. curve up. In parallel, the Bank of Japan has signaled it may deliver its first hike in years as soon as December, with Japanese 2-year yields rising to levels last seen in 2008. Near term, there are also technical pressures to consider. December brings heavy Treasury settlements and corporate tax payments, which risk draining bank reserves and could force the Fed to adjust its balance sheet tools to keep overnight funding markets orderly. At the same time, speculation about a more dovish Fed chair and criticism of the current communication framework raise questions about policy credibility. For allocators, the combination of rich easing expectations, above target inflation, potential Japanese tightening, and looming liquidity strains suggests that volatility in yields and curves around the upcoming meeting, the PCE prints, and key labor data may be more important than the headline decision itself. Credit markets present a calm surface with more troubling currents underneath. Investment grade and high yield spreads are hovering near historically tight levels, with history showing they have been wider the vast majority of the time. At the same time, there is clear evidence of rising distress and select defaults, especially in parts of the private credit universe, even though headline default rates remain benign and high yield benchmarks have performed well year to date. Private credit has enabled many companies that could not refinance via traditional markets in 2021 and 2022 to secure funding, but that support has come with more opacity and concentration. A record share of borrowers in that space now sit at the lowest credit tiers, including CCC- ratings, and there is a noticeable pickup in payment-in-kind features and selective defaults among mid-market issuers. Commentators argue that the period of clear outperformance for private credit has ended, with public credit now offering similar or better returns, higher quality, and more diversification. Overlaying that, tech and AI-related borrowers are driving a record wave of new issuance. Projections suggest as much as $1.5 trillion of incremental tech debt by 2028, largely funding data center and infrastructure build-outs. For now, markets are absorbing this supply, particularly from high-quality issuers tied to hyperscalers. But for lower-quality credits without that backing, spreads have already widened and yields have moved materially higher, reflecting investor demands for more compensation as leverage builds into a still uncertain rate and growth backdrop. Looking ahead, the driver of any Fed easing could be as important for credit as the magnitude. A cut motivated by clear improvements in inflation, with growth and employment holding up, would likely be manageable for most balance sheets. A cut forced by labor market weakness or broader economic stress would be more threatening for both public and private borrowers, especially given today's tight starting spreads. Some allocators are already favoring more defensive positioning and explicit credit protection, arguing that risks in both duration and spread are not fully appreciated, even as others see scope for credit returns to rival equities if growth stabilizes and a new cycle of mergers and issuance unfolds into 2026. In foreign exchange, the dollar sits at the intersection of aggressive Fed cut pricing and lingering concerns about inflation and institutional credibility. Market expectations for a December cut above 85% have already weighed on the U.S. currency and lent support to the euro. However, if the Fed signals only 1 or 2 cuts over the next year, or leans harder on upside inflation risks, that could quickly trigger a reversal, supporting the dollar and sparking volatility across currency pairs. Japan and the United Kingdom add further layers to the story. The sharp repricing of Bank of Japan policy, with markets now seeing a very high probability of a hike by January, has driven Japanese yields up and strengthened the yen, challenging carry trades that have long funded risk positions globally. Sterling, by contrast, faces medium-term downside risks tied to domestic political uncertainty and expectations that the Bank of England will ultimately cut more than is currently priced. Emerging market currencies look vulnerable in aggregate, given high debt loads and ongoing uncertainty, even though some investors now argue that select emerging economies offer better fiscal discipline and are no riskier than developed peers. Crypto assets continue to behave as a high beta expression of macro sentiment. Bitcoin and Ether sold off sharply as December began, with limited dip buying, mirroring the broader risk-off mood around doubts on U.S. rate cuts. The profitability of popular basis trades in Ethereum exchange-traded funds has collapsed as yields dropped from near 20% to below 5%, contributing to outflows, while uncertainty over tax treatment of staking remains a deterrent for some institutions. At the same time, MicroStrategy still trades at a steep premium to the value of its underlying Bitcoin, showing that pockets of speculative appetite remain. For allocators, currencies and crypto look set to be key release valves for any surprise in Fed or Bank of Japan communication over the coming weeks. Commodities are sending a powerful, but nuanced, message. Copper prices are pushing toward record territory as tight mine supply, new smelter demand, and the prospect of U.S. tariffs on refined metal squeeze the market. Silver has surged even more dramatically, with prices now close to double where they started the year, driven by persistent supply deficits, very low visible inventories in China, and the same expectation of Fed easing that is moving rates and currencies. Together, these moves signal belief in a sustained capex and electrification cycle, but also raise questions about speculative froth. Precious metals are also standing out as preferred hedges. Gold is widely expected to extend its rally into next year, underpinned by ongoing central bank and retail buying and by worries over fiat currency debasement. Some commentators argue that, relative to crypto, gold and silver offer a more reliable form of insurance against currency and policy risk, given their lower volatility and fewer regulatory headwinds. That perspective fits with broader risk-off behavior, including high allocations to money market funds, and reinforces the role of metals as both a hedge and a beneficiary of lower real yield expectations. Energy markets add a geopolitical overlay. Crude prices have firmed, with oil up modestly as OPEC Plus pauses production hikes for early 2026, even while the group worries about potential oversupply. Ongoing tensions around Ukraine and renewed focus on European defense, as well as U.S. policy uncertainty toward Venezuela, keep a risk premium in the complex. The combination of rising industrial metals and resilient energy prices, alongside markets that are heavily positioned for Fed easing, highlights an important cross-asset tension. Any renewed inflation spike, whether driven by commodities or tariffs, could force a policy rethink and quickly unsettle the current liquidity-driven support for risk assets. Stepping back across asset classes, markets are entering December with a delicate balance. Equities lean heavily on AI leadership and the promise of Fed cuts, even as valuations and concentration remain stretched. Rates markets price a swift easing cycle despite inflation staying above target and central bank messaging coming under strain. Credit spreads are tight while signs of private credit stress and heavy tech issuance accumulate under the surface. In foreign exchange, the dollar, yen, and sterling are all responding to shifting rate paths and political risk, while crypto continues to amplify swings in macro sentiment. Commodities, especially copper, silver, and gold, are signaling both confidence in long-term investment cycles and persistent concerns about inflation and currency debasement. Allocators may want to watch upcoming Fed and Bank of Japan decisions, inflation and labor data, AI earnings and capex, and any turn in credit quality or commodity prices as key catalysts that could break today's uneasy equilibrium. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.